The Reserve Bank recently wrote to all banks and NBFCs to be careful about retail, especially unsecured loans. Now, is the regulator worried about banks and NBFCs? Why is he worried? Is there a sharp rise in some kind of unsecured loans like personal loans, credit cards? Are there more defaults in this personal loans category? We have a report from CIBIL which shows that for the quarter ended December 2022, home loans, which is a secured product, actually dipped. But personal loans and credit cards, which are largely unsecured, rose the sharpest. Now, CIBIL's press release also points out that NBFCs showed the sharpest rise in personal loans compared to pre-COVID levels in particular. Not much of a rise if you look at PSU and public sector banks. And now let me come to the troubling table from the CIBIL release. Collection efficiency for personal loans and credit cards appears to have fallen from the previous, the December quarter from the year ago quarter. Also, if you look at delinquency, now by delinquency, CIBIL means borrowers who delay their interest payment by more than 30 days within the first 6 months of getting a loan. That category has risen very clearly for personal loans if you compare it to pre-COVID levels. Now, this is data only at the start of the rate hiking cycle. With rate hikes getting passed on, should we expect more delinquencies? I have with me probably the best of panels, Sir Rajesh Kumar, MD and CEO of CIBIL, who is, of course, the person who has put together this data. Shanti Ekambaram, she is the whole-time director and person in charge of consumer banking at Kotak Mahindra Bank, and Karthik Srinivasan, Senior Vice President and Co-Group Head, Financial Sector Ratings at ICRAL. Shanti and gentlemen, thank you very much indeed for joining me. Rajesh, I'll have to start with you since this is your report we are largely discussing. RBI writing to banks, do you think there is enough fodder in your report to worry them?
Good morning, Latha. Good morning to all of you. I think, first of all, we've had a good run for 2 years of very robust growth. As we say, probably the only shining economy in the world. So we've had growth across products, we've had growth across age groups and demographics, we've had growth across almost all states in the country. Now, when RBI talks about a little bit of a caution in unsecured loans, I think it's very timely advice and very prudent, because this growth story has to continue, and the only way it can continue is to ensure that there's responsible lending all around. And there are, whenever there is a lot of growth in retail lending, there are bound to be small pockets where you will find a little bit of an issue with volume and velocity, and that's happening in a small portion of unsecured loans below 50,000 in particular.
Okay.
So I think it's very timely advice from RBI, good to be a little more cautious in these few segments.
I'll tell you why I'm asking you this question, because, you know, some parts of your press release are actually showing a good picture. I'm particularly looking at upgrades and downgrades. You're saying that the number of upgrades has risen. The number of people in the same level, same loans, are actually higher at 41. A number of downgrades have fallen from 28% to 20%. So it's also giving a mixed picture. Personal loans, delinquency higher, collection efficiency down, but the number of downgrades are also falling.
So that's a great question, Latha. So actually what's happened is, in the last 2 years, we've seen a huge change in the retail lending portfolios. So if you look at it sheer volume-wise, the number of loans below 50,000 and on very short tenors like 3 months, 1 month, 6 months, they're very high. So within personal loans, 82% of loans on volume are below 50,000, though it's only 8% on value. Now, all of what I'm talking about at a total retail plus MSME book is less than 1% of the total book at a country level. So it's a very small book, but very high on volume and velocity. That's why what you're seeing in that report is that all the others, you see good indicators everywhere else, and you see the small increase in a small segment of personal loans below 50,000.
Okay, so that's the category to worry about. Shanti, now to come to you. This is not really a banking sector priority area, isn't it? I mean, I would think that 50,000 and below would more be NBFC fintech kind of loans. What has been your experience with small loans?
So firstly, Latha, I want to just add to what Rajesh has just said. There has been phenomenal growth, and there are 2-3 reasons for that. One, post-COVID consumption. Second, credit being available at the point of consumption, what you now call buy now, pay later, or whatever it is. Credit being available at the point of consumption. And third, rich data and data science models being available to make credit available online real time. I think this has changed the trajectory of consumption finance, as I call it, which is largely unsecured loans. Okay. Now, if you saw the numbers of all the banks and even the large NBFCs, you're seeing no signs of any stress or delinquencies, and everybody is saying it is looking too good to be true, and there is a stability. So I think it is very largely an NBFC play, but I don't think banks are completely out of it. Like I said, it is at point of consumption. The advantage that banks have is the amount of transaction data. CIBIL provides wonderful data, but the amount of transaction and other data that banks have to be able to offer credit at the point of consumption is really large. And lastly, let me tell you, with credit on UPI becoming available, which is really the payment point at point of consumption, this is going to go up even further. But 2 things are important. One, lending is the easier part. Collection is the more difficult part, particularly in loans of below 50,000 rupees. People need to have their collection mechanisms in place, monitoring and collection, which is not easy. Probably why the central bank has cautioned to say it is not just enough to lend, and that may be one of the reasons why you are seeing, the DPD that you talked about, 30-day increasing, is collection mechanisms must be in place and keep speed with the disbursement that is happening. Second, this is largely personal loan, but there is a commercial end of the loan, business loan also, which is increasing, which so far has not been discussed. Oh, okay. So this is broadly how I think.
Okay, no, but Shanti, how does a bank inform us, and I guess even inform themselves, about weakening loan parameters? You tell us NPA after it's an incurred loss. And then you'll tell us about SMA 1 and 2, but I think that's more for large loans, 5 crore plus. Is there any way you keep track or you tell us in your results about these smaller ticket 50,000 rupee kind of loans? Are you aware whether they are in good health?
Latha, banks monitor from 0 DPD, plus 1 DPD, not just 0, plus 1 DPD, then 30 DPD, and then thereafter. When it reaches plus 1 DPD, all banks monitor the plus 1 to 30 very closely. Because in the unsecured business, if it crosses 30, right, your recovery percentages go down when it goes beyond 60. Banks actually have very strong monitoring mechanism at plus 1 DPD.
And are you feeling reasonably and are you feeling reasonably sure about your own portfolio in
absolutely those? Absolutely. See, I come back to this, Latha, is that the data science available, the big difference from pre-COVID to now is the quality of data that is available, the quality of transaction and other patterns that you have, that you can qualify customers. Okay. Most banks insist on 700 plus. That's now become a norm across the industry, 700, 750 plus. But I think the enrichment happens from the data science, but that alone is not enough. Monitoring and collection is equally important. And right now, system seems to be managing it reasonably well.
Okay. Well, Rajesh's press release is also saying that more loans have been given to the near prime category. Prime and subprime have remained static or even a little less. But in terms of loan origination, near prime, that means a little more risk is what banks and NBFCs seem to be taking. Now, Karthik, if you put all this together and your own data at ICRA, what is the sense you're getting? If this is still early stage rate cycle getting passed on, a little more is going to get passed on as the reset period comes for various loans. So do you see red flags at all, especially in unsecured loans?
I'll say in terms of interest rates, the borrowers have seen higher rates in the past. For the last couple of years, the rates have come down. Now they're again on their way up. So the new rates are not something that the borrowers have not seen in the past. So we believe that they should be in a position to navigate through a rising loan interest rate scenario as well. At a broader level, whenever a segment grows very fast, we are obviously a bit concerned about that. We remain cautious. Even now, it's not a handful of entities, but basically most of the players, large or small, have grown pretty sharply over the last 12 to 18 months. If we were to just look at it at a slightly longer horizon, last CAGR of last 3 to 5 years, maybe the numbers won't look as high as what one looks at for the last 12 to 18 months. But clearly, as Rajesh and Shanti articulated, the quantum of data that is available today and our interactions with banks and NBFCs, there is clearly a preference for better rated or borrowers with higher credit scores. To that extent, the cherry picking of portfolio is definitely happening.
Okay.
We also understand and believe that the approval rates are coming down because there is so much of consumer demand which is coming at the ground level, which enables the lenders to sort of cherry pick the borrowers whom they want to onboard within their broadly defined risk parameters. And more importantly, if we were to look from a rating point of view, an additional comfort that we derive as of now is the fact that the balance sheet of banks and NBFCs have actually strengthened over the last couple of years.
Okay.
The incremental regulatory measures have also ensured that the liquidity profile is stable and entities should be in a position to manage little bit of volatilities here or there.
Fair point. Okay, got that, Karthik. We have to take a quick break, but we have lots more questions on how competent is this data footprint, the digital footprint that Shanti has been talking about, and whether we should start seeing more, delinquency as interest rates start getting passed on. All those questions after the break.